I was in New York a couple of weeks ago at a conference and this guy Saylor was talking. I mean, I've never heard more financial nonsense than what came out of that guy's mouth ever in my entire existence in this career, in 30 years. Anybody who had experience in finance in that room, all of us were talking about, what the hell is this guy talking about? Nobody understood it. The math made no sense, and it still doesn't. With Saylor, his premise is based on borrowing and using that for a high velocity instrument like Bitcoin. The problem is when you have people like Saylor borrowing at 12.5%, okay, on preferreds, that's a really dangerous place to be, because what happens is you screw your preferred shareholders over. Then what happens is your MNAV drops below the actual price of Bitcoin. That gap seems to be closing in on itself. When it does, then that guy's in a lot of trouble, because his leverage is huge. I think Michael Saylor's right about owning Bitcoin long term, but is it right to buy a treasury and to think that a treasury knows more than everybody else out there as far as how to manage a treasury asset? I don't think so, man. Like, no way. No way. I think it's dangerous. If you don't have that kind of disclosure and transparency in this market, you better be focused on something that does have that transparency and disclosure. And that's where our Hedge product actually fills a gap. You better hedge yourself, because people are counting on that money to be there. We want to bring in those investors who are on the sidelines. We're looking for reliability and transparency, because at some point they're all going to blow up. The ones that aren't kind of hedged, and the ones who are hedged are going to cannibalize those that weren't thinking about it this way.
Welcome to Sat Chats, the Bitcoin podcast where we chat about sats. Sats are the smallest part of a Bitcoin, the same way pennies are the smallest part of a dollar. With Sat Chats, we are building the world's biggest Bitcoin welcome center to serve as your gateway to generational wealth. So if you are brand new to Bitcoin, we want to chat about sats with you. Head to satchats.com to grab your slot in the studio today. I'm your host, Stuart.
And I'm your co-host, Anna Bevan.
And we've got number 129, Patrick, is in the studio today, CEO of DelphX. Patrick has got himself a Bitcoin story and a pretty interesting take on Wall Street, kind of like falling behind. And like, I think before we started, he said Wall Street asleep for 2 decades. Yikes. So, Patrick, why don't you introduce yourself to our Satillionaires? Let us know who you are.
Sure. Hey, guys. I'm Pat Wood. I'm the president and CEO of a company called DelphX Capital Markets. We're a public company. We're based out of New York and Toronto. And our MO has been to develop new structured products for generally the credit markets over the last several years. But recently we've adapted our structure to the crypto markets for a variety of reasons, but I can dig into that a little bit more, Stuart.
Patrick, you have got lots of experience in the financial realm, and you talked about how you make new products at DelphX, but then have adapted that to the crypto realm. So maybe tell us a little bit about what you mean, and then we can go from there.
Yeah, so why don't I go back to the start? The start is probably 2013. I was fascinated by smart contracts because there was a group actually out of Toronto called Ledger Labs. They developed this thing called Ethereum. And so I met those dudes. They were introduced to me by other people in finance at the time. And I thought, gosh, smart contract technology, that sounds really cool. And I'd already been kind of getting up to speed on blockchain. And I thought, gosh, this is a great disruptive new platform for what I thought was like for pretty much everything. Anyway, I went to Consensus, which was like, a blockchain conference in New York that year. I think there was only like about 200 of us there. It was a small little gathering. I gather now these things are in the thousands, but it was really cool because the governor of Delaware was there, and he was talking about how he was using smart contract technology within their actual, their state ecosystem. So for garbage collection, they were using smart contract technology. For paying a federal or state employees, they were using smart contract technology. And I thought, gosh, what a disruptive, awesome, way to go. And so Bitcoin became, very interesting to me, but it was more, as did Ethereum, but it was more the backdrop. It was more the blockchain ecosystem behind that I thought, gosh, this is super compelling. So I originally got involved for that reason, and then at the time I was running my own merchant bank / advisory / investment bank, and our premise was to take U.S. companies public, so smaller U.S. companies that weren't really getting much love or recognition by the Wall Street crew. And actually up in Canada at the time, it was an easy way to take companies public. Back then there was a buoyant financial system that was really kind of focused on high growth, small companies. And so, we took a few crypto, blockchain payment systems public at the time. One of them happened to be this company, DelphX. DelphX at the time was developing kind of a blockchain platform around kind of credit default swaps, which is a whole other story. I won't get into that. Anyway, the management group at the time blew the company up, as happens with some of these startups. And anyway, so I reluctantly stepped in to kind of fill the role of interim CEO 5 years ago. And anyway, we didn't really think about Bitcoin or crypto for that time period. We were really focused on the credit markets, and so we developed a really cool credit market product. And I can get into my bashing of Wall Street in a sec, as far as their lack of innovation and how we were able to develop something really cool like that. But at the beginning of the last summer, we were approached by a fund down in the States here. And they said, hey man, you know what, we want to use your little company, your little public shell to do a treasury, a DAT. And so digital asset treasury, we said, gosh, there's so many people doing that stuff right now. That's probably not the right place for us to go. It's because we're kind of thinking, longer term with this little company of ours that, we want to do something really good and really, fill a gap that's out there. And anyway, we started to think about it, and we thought, gosh, you know what, crypto is really in need of some love here on the downside. You have a lot of different products like OTC options. You have things like IBIT, puts and calls. You have a very, very active derivatives market, but it's one of those markets that has zero transparency. The amount of leverage in the system, which has just been proven over the last couple of days, is massive. You got guys trading 50 to 1 right now. These are ratios that we didn't even have in Wall Street back in 2007. I mean, you're talking about insane leverage in a system that is built on good things and a good philosophy. But when you're building these things called treasuries around Bitcoin and other crypto assets, you shouldn't be in that business because a treasury is meant to be safe, secure, etc.
Are you saying that there are people trading Bitcoin at these highly leveraged 50 to 1 ratios, or is that just the crypto casino where you have the other tokens?
That's right, man. That's right. So you have a market now where people like Coinbase and others are offering people 50 to 1 leverage.
On Coinbase, you can get 50 to 1 leverage on Bitcoin?
Yeah, so there was an announcement over the weekend on that. I think it was Coinbase. It was one of them. It was one of the big guys, though. I got to be careful not to knock names, but anyway, that being said, yeah, one of the big exchanges announced a 50. They said, forget about this, 20 to 1, forget about it. We're actually going to increase it 50 to 1. So that's the kind of insanity out there. But what's even beyond reproach is the fact that you got people like, and I hate to pick on them, like Metaplanet, but you show me a business model that's more vulnerable to insanity than that. They're basically writing naked put options, saying that they've got the money to back it up, but they're not giving the street any disclosure on the exercise prices of those options, the strike price, so the maturity, anything. There's no color on the backdrop. It's kind of like AIG in 2007, giving people insurance on their housing bonds, their mortgage bonds essentially, but not having the backdrop to do it. Basically just writing the ticket and stuffing it in a drawer, taking the whole organization and the rest of the world and the market down with it. You got the same narrative at play, and I'm not saying Metaplanet is doing anything bad, but where's the disclosure? And if you don't have that kind of disclosure and transparency in this market, then you better be focused on something that does have that transparency and disclosure. And that's where our hedge product actually fills a gap that's not there. And by the way, I don't mean to be a doomsayer. Like, I'm not at all. I was in New York a couple of weeks ago at a conference, and this guy Saylor was talking. And, I used to sit on a preferred desk, and I used to sell a lot of preferred shares back in the day. I mean, I've never heard more financial nonsense than what came out of that guy's mouth ever in my entire existence in this career, in 30 years.
Well,
and I remember, by the way, the last time he bamboozled the market in 2000, when he had 2 quarters of false growth, and they had to misstate their financial kind of representations. And they knocked not only MicroStrategy shareholders out of the water, but they smoked the market as well.
hang
I'm
on.
not saying the same thing's going to happen, but I am just kind of saying, hey, everybody should be on guard here. And people should open their eyes a bit more.
Most Bitcoiners who have been around for longer than a year or two feel like Michael Saylor is the Chad. They feel like Michael Saylor is absolutely yeeting himself into Bitcoin and creating an infinite money glitch where he borrows cash to buy Bitcoin. He turns around with the Bitcoin as an asset to get more cash and buys Bitcoin and is just like 100%, I don't know, like cheat coding his way to the top or something.
Yeah.
But what I'm hearing from you is 2 things. Number one, or I guess let me do a not only but also real quick. Not only did you listen to him recently and decide that what he was saying was total nonsense.
And it wasn't just me. It wasn't just me, by the way. Okay, anybody who had experience in finance in that room, all of us were standing outside having cigarettes and hanging out, talking about what the hell is this guy talking about? Does this make any sense to you? Like, dude, nobody understood it. And I can tell you, the math made no sense. And it still doesn't.
So
Wow.
not only that, which I want to hear about,
Yeah.
but also you've been around long enough to remember a time when he did some 2000 or 2001 shenanigans as well. So
that's it, dude. Yeah.
let's work our way backward. What was the thing that he said recently that did not make sense to you or other people who have been around for a while?
With Saylor, his premise is based on borrowing and using that, once again, for a high velocity instrument like Bitcoin. Which, by the way, okay, like over the last 10 years, the current annual growth rate on Bitcoin's been about 84%, right? It's a great growth rate. And so long-term Bitcoiners, like me, we kind of believe in it. Like it's going to continue to do well. And I think long-term, people are saying $1 million of Bitcoin. Sure, why not? That could easily happen. I think definitely the wind is behind the sails that it's going to get there. The problem is when you have people like Saylor borrowing at 12.5%, okay, on preferreds, and in a room of people, okay, like hundreds of people at this conference, saying stuff like he doesn't need to pay the dividend on those preferreds if he doesn't want to, or if things get tough. Well, that's a really dangerous place to be, because what happens is you screw your preferred shareholders over. No one's going to step up to finance you and fund you going forward. Then what happens is your MNAV drops below the actual price of Bitcoin, which by the way, the last year, MicroStrategy is actually doing worse than Bitcoin. You would have been better to own 1 Bitcoin than owning shares of MicroStrategy. It's over the last 5 years, sure, it's done great. But listen, man, that gap seems to be closing in on itself. When it does, and if it does, then that guy's in a lot of trouble because his leverage is huge. God knows what's underneath the hood. What's his new strategy? I mean, he spoke at this conference about developing new credit products around Bitcoin, which is like, what are you talking about? Like, what are you going to develop a Bitcoin mortgage or something like that? And you're going to become a new bank, which is what he wants to be. He wants to be a new bank. Problem is, this bank is borrowing so much money. They're not borrowing at Fed funds. This bank's borrowing market money, basically on a CCC- bond rating, which is the last time they were actually rated. They're probably more like paying default rates on their debt now. And let's face it, when you have big shocks to the system, and God forbid you have more than one FTX the next time things get smacked, then that's going to create a big rush to the exits. And that's when all the leverage in the system becomes transparent. And that's when MicroStrategy really gets spanked. So I think Michael Saylor's right. I think he's right about owning Bitcoin long term. Absolutely. But is it right to buy a treasury? And to think that a treasury knows more than everybody else out there as far as how to manage a treasury asset? I don't think so, man. Like, no way. No way. I think it's dangerous.
So are you saying one of your problems with Michael Saylor is that you think that he's advising people to follow in his footsteps incorrectly, or he's poorly advising or disclosing to his shareholders?
So I think he's
both?
I mean, I can't comment on any of that other than the fact that his math didn't make sense to me.
Okay.
And he's calling this a movement, right? And, you know, Jim Jones called it a movement too at one point. It was like, drink the Kool-Aid. And, you know, that didn't work out for everybody. So, you know, that's what worries me about an asset, which is supposed to be a treasury asset. It's supposed to be hedged. Like, he's supposed to be protecting people from downside. He's not looking at doing that. And so that's bad. That's being a bad steward to a treasury asset management strategy. And you're really, at that point, I think, you know, you're really looking at, I think you're looking at the world through rose-colored glasses. And I think you believe that all of the danger out there is going to be, you know, just washed away magically somehow. That doesn't always happen. With the amount of leverage out there, and in business models that make no sense to just lay people like myself. Like I said, at this conference, there was a guy who was in real estate, smart guy, you know, built a real estate empire. He's like, Pat, does this make any sense to you, the math? I was like, dude, I got to tell you, no chance. This doesn't make any sense.
It sounds like you feel that Michael Saylor and his company MicroStrategy, along with some other companies like MetaPlanet, maybe I think Similar Scientific is another name I know of that has really put a lot of Bitcoin onto its balance sheet. Yeah. Similar to AIG in the run-up to the great financial crisis, are basically making choices that only really work out so long as everything goes up all the time, no matter what. And the moment something pulls back or drops down, then this kind of over-leveraged house of cards will come crashing down. And if you don't have some type of protection against the downside, if you don't have some kind of hedge against the downside, along with some recommended transparency in the strategies currently being pursued, then you might end up regretting your decisions.
Yeah. So puts and options, essentially, is actually a bigger market than crypto now. In fact, there's so much activity in the derivatives space. You know, people basically day trading and whatnot, and I run across it all the time. And, you know, they think that, you know, they're doing great, that they know what they're doing, etc. But that kind of unfettered activity in derivatives is nuts, because you've got basically strategies in place. You have exchanges that are kind of like the Wild West still. You know, they shut down the minute something really bad happens and freeze people from trading. So you have a market that's very active with day traders and people who are not taking a long-term view. They're just punters, and that's what's very dangerous. But beyond that, you have large companies like MetaPlanet. Their whole business model on making revenues is to write those options themselves. So they're saying, hey, man, you want to buy protection? No problem. We'll be your counterparty. We promise you we got the money in our balance sheet. We'll pay you. But how do you know that? Like, how do you know that the money is there? Because in their financial results, they're not disclosing what the nature is of those options that they're writing, right? So it's a very dangerous spot to be. Because if you really have a bad market, and a fast market sometimes, this market, I mean, very likely that a lot of these people writing these options would be dead meat. And so that would cause a big run on the exchanges. It would cause chaos in the system, and things would be really, really bad. But that's how close we are to that kind of moment happening. Our approach to it is more like, okay, if you're a sailor and you've done really well at this stage, you know that to sell a treasury as being a safe asset to people, like, hey, buy me because I'm going to do better than Bitcoin over the last 5 years, certainly not over the last year. In fact, like I said, Bitcoin's done better than strategy. But, if he's going to take that view and be a good steward of that treasury, he's going to say, okay, you know what, we're going to give up a bit of upside and buy a hedge here. But we know that hedge isn't underwritten by MicroStrategy or by my MetaPlanet. It's written by somebody who's actually taken that downside money. It's sitting at a custodian, i.e. US bank, and is sitting in treasuries. So there's no messing around with that collateral. So if things go real bad, I'm going to get my hedge. It's going to be, it's going to come whole for me. Make sense? So
honestly, that's hard for me to follow. It sounds like you're saying, if you have, decided, if you've done really well in kind of a risky leveraged scenario, then it's a good time to start kind of swooping some of that into basically something that's rock solid. Because the way that I approach Bitcoin, Pat, is that I want to take care of my own Bitcoin myself. It's with me. I control the keys. It is not on an exchange where an exchange could do something squirrely with it. Yeah. It is not rolled into a financial product like Michael Saylor has done with his company to try to get even more gains. Because to your point, I heard you say that over the past, I think, 10 years, the average increase in Bitcoin's value is 84% a year. That is, that's plenty good for moi, personally.
That's a lot.
I'm okay. I'm okay to work hard, make some money, not spend all of it, take the rest, buy Bitcoin, and hang out with it long term while it increases 84% a year for 10 years. Mm-hmm. I really don't like getting upside down. I don't like overextending myself. I prefer to have all my pieces on the chessboard supported by other pieces on the chessboard. And what it sounds like you're saying is Michael Saylor has taken his queen and just run it to the other side of the board with no supporting pieces. And he's saying, look, guys, I'm going to put the stuff in place to support that queen. By the time she's under attack, it's going to be fine.
Yeah. So a little bit to talk about there, Stuart. So your approach to this, having a hard wallet, keeping your keys, etc., not being on an exchange, taking a long-term view, taking your savings off the table and putting it in Bitcoin and saying, yeah, man, I'm cool with this for 10 years. I'm going to sit with it. I don't care what it does on a day-to-day basis. Awesome. You are doing it right. 100%. I would recommend everybody do that. That's a no-brainer. But when you are, when you're raising billions and billions of dollars, okay, and the model is supposed to be like, hey, we're a treasury, and this is where you can put your money, like Stuart and like Anna Bevan did, and, kind of doing it on their own. It's safe, it's secured, we're taking a very long-term view on this. We don't need to worry about anything. So that's a different approach. What these guys are doing, though, is they're saying, hey, we have strategies that we're doing internally that are going to generate alpha. They're going to generate a better return than Anna Bevan and Stuart are getting. And we're going to keep raising, we're going to borrow money to do this. And, we're going to lever the whole freaking thing up. Well, that's very different than what you guys are doing. What you guys are doing is perfect. My point is to these treasuries, it's like, hey, if you're going to market yourself as doing something like Stuart and Anna Bevan are, then you better hedge yourself, because people are counting on that money to be there, i.e. pension funds are now, okay? ETFs are counting on that money to be there. Asset managers, family offices, they're buying your stock They want that guarantee that there's going to be some downside. And let's face it, the whole premise of your show is to bring new people to Bitcoin. 95% of Bitcoin investors haven't invested in Bitcoin yet, right? And it's because of the stuff that I've been talking about. They know it's there, all these risks. And they don't have the ability to do what you guys do, hard wallets, all that other kind of stuff. They don't want to deal with that hassle. But if you could be the Treasury saying, hey, we're totally hedged. We're going to give you the upside. We're going to give up a bit of that upside. But, you know, as an investor who's conservative and safe, you're not going to have down 74%. Your maximum downside is going to be maybe 15%. Then that brings in a whole new gamut of investor. And that's what we want. We want to bring in those investors who are on the sidelines, who are looking for reliability and transparency. And that's what we want to bring to those treasuries that are smart enough to think about it. Because at some point, they're all going to blow up. The ones that aren't kind of hedged, and the ones who are hedged are going to cannibalize those that weren't thinking about it this way.
So it sounds like you're saying that you went to that conference and Michael Saylor said, look, I don't need to pay out dividends if things get a little shaky. And in your mind, you're saying, well, if you don't, then eventually like the quality of what you're offering will drop, the support for what you're offering will drop, and eventually you'll dip down to a point where all this leveraged business will catch up with you. And also, I really liked the distinction between Fed funds and market money, where I guess if you have access to Fed funds, it just sounds like, you know, 0% interest or 1% interest, kind of money printer, Cantillon effect. Like, dude, you're right next to the money printer machine and you're just taking the sheets of paper off of it real nice and easy. He's paying market money rates where it's 10%, 11%, 12%. So it's a costly endeavor for him. And you know, you're looking at the math and saying, I don't think this is all going to work out. And you're also thinking about how he did some hijinks earlier in time. I don't know anything about this. What were those 2 quarters in the 2000s or whatever where something was not correct? Tell us that story as well.
So same company, by the way. So 2 things. So yeah, don't actually take my word for it. It's on YouTube, that conference. It's called the Unconference. I'm sitting in the front row. You can see my ugly mug right in front of the guy for half an hour as he's giving his diatribe about, you know, what he's doing. And but yeah, check it out yourself. Don't take it from me. Go listen to the thing. So back in 2000, MicroStrategy, same company, okay, same guy. They misstated 2 quarters of financial results, and it was at the peak of the market, which, I mean, sounds kind of familiar, right? Peak of the market type thing, a little bit. There was a lot of leverage in the system back then too. Back in 1999, it was the OG kind of tech boom. It's when you had like Wi-Fi was a new thing back then, you know, so people were paying huge for Wi-Fi companies and broadband companies, and it was just mayhem. But MicroStrategy, because they were one of the guys in the space at the time, they were one of the well-known ones. They misstated, like I said, 2 quarters of financial results. And by virtue of doing that, the stock got, spanked, and it took down the rest of the market with it. So, you know, companies like, Oracle went from like $100 a share down to $10 a share. Like big companies. Microsoft got spanked. Everyone got totally obliterated. But, you know, it was a defining moment when MicroStrategy restated their financial results, because it really got people thinking like, oh my gosh, this is a really buoyant, over-buoyant market. And it's sell type thing. Yeah, it was the first tech market implosion, actually, was back then.
And you're saying that the tech market imploded after MicroStrategy had to restate its financials. So they were like the light that they were like the match that kind of lit the pile of tinder.
It seemed to be, man. Yeah, it was coincidental, but yeah, it was something, and it was bad. It was companies like one that I was following at the time was there were so many. Okay, like Intel, Dell, Oracle, all of the big guys, Microsoft, Celestica. Yeah, I mean, you had companies that were trading at 120. A year later, they were down at $10 a share, kind of thing. Like, it was that bad.
This is wild. This is a point of view that is absolutely counter to anything else I have come across in the Bitcoin slash,
But I agree with you guys, though.
Yeah.
Like, I'm with you guys. Buy your Bitcoin. Hold it forever. If you're savvy enough to build your own wallet and, manage it yourself using your own savings, heck yeah. I mean, you're not going to go wrong, I think. Longer term, it's going to do great. My worry is the Treasuries. That's my, that's where I'm shooting my arrows right now.
For individual regular people, you're saying, hey, just do what we do here on Sat Chats. Stack sats, stay humble, take them into self-custody, make sure you got your keys. Bitcoin, the Bitcoin in Saifedean Ammous's book, The Bitcoin Standard, is a form of money where there is no funny business. There just isn't. Either you have the Bitcoin or you don't have the Bitcoin. It's not like the US dollar where maybe you have it, maybe you print more and now you got more. It really appealed to me as a way to be more secure. But we do see companies effectively saying, look, man, no risk, no reward. Let's go absolutely hard on Bitcoin because we believe in it. And let's go use the traditional financial system to get even more Bitcoin than we can otherwise get because, hey, it's you can do it. But that's where your word of caution comes in. And that's where your hedging comes in. But how does DelphX hedge these Bitcoin treasuries? Are they just kind of selling some stuff off and buying some cash and putting it into a savings account? Or what? I mean, I don't get, how does it work?
Okay. So you got 100 million BTC, right? Let's assume the price on BTC today is 100,000, which funny enough, we were a couple of days ago at one point. But yeah, just assume you're at 100,000. Okay. And so you are not worried about 10% a year. You're worried about anything under 15%. So you're going to basically say, gosh, you know what? I'm going to buy, through DelphX, I'm going to buy a new security, which is essentially it behaves like a put option a bit. I'm going to pay a premium. Let's say I'm going to take 7% off a year. And every year I'm going to peel off 7%. So I'm going to pay $7 million for 1 year of protection, such that if Bitcoin drops below 15%, so below 85,000, anything below that I'm covered for. On the other side, the guy taking that 7 million is a hedge fund, and we have like several of them on this. And the hedge fund is saying, all right, man, I'm going to take your 7 million. I'm going to take $85 million, give it to the custodian, which is U.S. Bank. That's who we work with. And U.S. Bank's going to buy a treasury bill for 1 year. And that treasury bill, I'm going to collect the interest on it together with the 7 million that you paid me for the protection. I'm happy. Now, in the case that Bitcoin drops below 85,000, that treasury could say, all right, man, Bitcoin's at 50,000. So 35,000 of that, or 35 million in this case, comes to me now from that collateral fund that's sitting in the treasury. And so because your collateral's in a U.S. Treasury, it's solid as can be. You can't beat it. It's a 1 year Treasury bond. And so that's the ethos of what we do. And we sit in the middle as a broker-dealer. We act as placement agent, and we're the issuer of those two new securities. That's kind of how the process works. It's really simple, actually. Like I said earlier on, and I hate to go back to beating people up, but Wall Street should have invented this product. This is what they traditionally should have been doing. Last time they invented something new was back in the 90s. So for us to step in here and develop something like this, I think is pretty cool. Meantime, any new thing that we've developed, we've actually shown it to these guys at on Wall Street desks and in the bank itself in some cases. And even though we have great new products that we're rolling out, guys on Wall Street say to us, yeah, we just don't have the bandwidth, we love the product, etc. And really, that's just a bunch of old people trying to keep their jobs for another couple of bonus cycles. That's what it is. And that's the kind of mentality you've got now on Wall Street, is not to develop something new. God forbid they take a risk. Let's just keep milking people, by leveraging our Fed funds rate, charging people, higher amounts on mortgages and other things, doing stupid things like getting involved in subprime car lending businesses, which is a new thing that just came out the other day.
No.
Once again, yeah.
No. Subprime car lending, stop.
That feels
Stop.
like, I feel like I've already seen how that story ends.
The subprime, it's like, I hate it. I hate that word. Subprime mortgages destroyed my whole version of life that I was telling myself as I was graduating university with a master's degree directly into the financial crisis, which I believe was caused, at least to my level of understanding, by shenanigans. Basically packaging up subprime mortgages and trading them back. It's like, dude, why can't y'all, I just feel like there is this absolute insane urge to get returns faster than you ought to.
Yeah.
Yeah, of course. I love capitalism and I love taking risks, but when it's fraud, it's a whole different thing, right? And when you take too many risks and you're not checking you're not kind of checking the boxes off properly on due diligence, that's when things go bad. So subprime, in the news, just Google First Brands and Tricolor. Look at the guys that are getting stiffed right now with almost billions of dollars of pain. You've got primary dealers like the big banks in there getting bamboozled because they didn't do the due diligence on what turned out to actually be a big fraud in the subprime market on automobiles, which is hilarious. Can't believe these guys did it again. Like, seriously, such idiots. Like, they really are just complete idiots. And they don't do any due diligence. And God forbid they protect anyone from downside. The last thing they want to do. That's crazy.
It's crazy. For whatever reason, subprime mortgages at the time kind of at least made a little bit of sense. Like, it's a home is pretty good. A home kind of keeps its value so long as you measure it through the dollar. But subprime car is fully just like, that is clown. You are clowning around if you're somehow scooping up a bunch of car loans that aren't going so hot and like trading them back and forth. That's like, I mean, what's next? Subprime bicycles?
Well, Stuart, to that end, these things always start somewhere, right? These big market movements. Back in the day in 2007, it was Bear Stearns had two funds, just basically implode in August, I think, of that summer. And it took a whole year before the whole market caught up with it, with all the leverage and all the, the fraud, and essentially fraud is what it was. And then they got all bailed out. Stuff like this, what's happening right now with Tricolor and First Brands, Saks is, basically that was an awful one that happened too. Fortress just got spanked, so I think it was called New Fortress Energy. They just lost a whole ton, with basically bad debt. So who knows where it's going to head, but it really does make more of a case for hedging right now because you got a lot of stuff in the system that's dicey. And so that's the position that we're taking on it. But now that being said, long term, who cares? If things pull back, if you're basically a mom and pop type investor like us, you know what? Great, man. We're going to buy more Bitcoin, put it in our hard wallets, and we're going to be happy to do it. In fact, we really want it to come back to 50,000. That would be awesome. I mean, time to back up the bus and
yeah.
average down.
Yeah.
Like I would. I mean, why not, right? But I'm not running a treasury, and my fiduciary responsibility running a treasury to shareholders and investors is not the same as what we have. We're taking care of ourselves. We have our savings. But these people who are running treasuries, just by virtue of calling it a treasury, they have a fiduciary responsibility. They're not filling those responsibilities right now. And they, in turn, are probably going to take down the whole market as they themselves implode.
Wow, that's fascinating.
So it sounds like if you are a company with Bitcoin on your books, you should consider some type of hedge and a level of transparency that will help you not get wrecked if and when all of the other companies out there that are being less responsible do get wrecked and pull down that market.
You got it.
If you are a regular old person, the way that you can hedge against all of the nonsense that seems to happen every certain number of years and wrecks all of us is just to stay humble, stack sats, don't spend more money than you have, put your savings into Bitcoin and just freaking hang out with it, because no matter how hard you try to find different ways to make more money than you ought to in the marketplace or through private deals, some clown is out there packaging up subprime car loans that is going to explode in his own face, okay? Like Seamus Finnegan trying to cast Wingardium Leviosa on that feather, and it's going to explode everyone around him and the companies and the market, and you just can't protect against people clowning around with these crazy leveraged derivative yada yada. It's just too much.
Yeah.
It's just too much.
Yeah. That's it, man. Yeah. But you know what? To that end, your idea about dollar cost averaging, just saying to yourself, okay, every month or every 4 months, I'm going to, buy some Bitcoin, and just, no matter what the level is. If it's at 50,000, I'll buy some. If it's at, 150,000, I'll buy some. Just be disciplined. Dollar cost average into the thing, man, you're going to build a great retirement. If it holds up, which of course it will. I mean, look, longer term, the fundamentals clearly support Bitcoin doing really, really well, becoming a reserve asset to some. The supply-demand fundamentals are really there for it. Like I said, from our point of view, long-term, big believers in it. In fact, at some point, we might even create our own treasury at DelphX. But for now, we just see that there's too much volatility in the sense that the shenanigans are clearly at play, Stuart, and they're going to come to roost. So I think the guys who are thinking about that and who acknowledge it and protect themselves and their investors are people who are going to do well. And they'll cannibalize everybody else. So, that's going to be great.
Well, Pat, there's clearly more to Bitcoin and the subprime shenaniganry that wraps itself around every freaking financial option in the world than we'll ever be able to fit into a single chat about sats. So we do ask each of our guests if they would be willing to come back on in 9 months to give us an update on their Bitcoin baby. Would you be willing to do that for us?
Of course, man. Yeah, 100%, guys. And really a pleasure talking with you guys both.
So thank you for doing that. October, November, December. I don't know months unless I go in order. January, February, March, April, May, June. So near the end of June. Okay, could be around that Independence Day situation. You will be back on. What is your prediction?
I think we're going to have a lot of alliances and partnerships with exchanges in the space who understand the value of the transparency, full collateralization thing that I was talking about. And I believe that, the market itself might, if it hasn't already, then it will be setting itself up for a blow off the top from the Treasury perspective, which unfortunately will filter down to the actual cryptocurrency as well.
Let's turn it over to Ithaca Hummus.
Yes. So our founding sponsor is Ithaca Hummus. One of our founders, Chris, is the CEO and founder of Ithaca Hummus. And so we are fortunate to have it, and we love it.
It's really tasty. I'm going to serve as your taste buds here today, Pat.
Yes. And so we are tasting for today The roasted red pepper.
This is like the most colorful one.
It is, very much so.
All right,
okay, ready?
cheers. So that was scrumptious. What do we got next, Abes?
So now we would like to make you an offer. So at Sat Chats, we believe in value for value. And in exchange for your time and coming on our show, we'd like to give you an offer and to choose between $50 in fiat or $50 in Bitcoin, which at today's rate, our exchange is 43,750 Satoshis. What would you like to choose?
Bitcoin, guys, obviously.
Bitcoin, guys,
Excellent.
obviously. Bitcoin, guys, obviously. Pat, you bring our show's scoreboard to 126 who have stacked the sats, along with 9 who chose good old General Ulysses S. Grant. Woof.
We are counting down to having those 9 back on the show.
Yeah. We're going to keep
we think
working on
time
it.
will be our friend.
Exactly. We're going to say, do you want the same money that's powering the subprime car lending market? No. Get some freaking Bitcoin. Where can our satillionaires listening in the audience go if they want to engage with you and DelphX?
Yeah, sure. Just check out our website, DelphX.com. Yeah, it's a stupid name, long story, but it came from way before my time. But anyway, that's DelphX, so DelphX.com.
Dang. Pat is 100 just saying the truth
he's
out
just
loud.
out there.
I'm the CEO of a company with a name I don't like.
Yeah.
And I
hate it.
appreciate
Yeah,
that. I appreciate that.
embarrassing.
It's embarrassing. Yo.
So do you not have any branded items that say DelphX?
Unfortunately, we do. Yeah, we have some business cards and some other stuff. But yeah,
So maybe in 9 months we'll have the rebrand as well.
Yeah.
I sure hope so. Yeah, we'll definitely do that. So
It'll be hedgex.com.
Oh,
there
to
you
the
go.
point.
That'd be awesome, dude. That's a really good idea.
Well, there you. Hey, holler. Yeah. And
Wait a minute, I might give you $50 in Bitcoin instead.
Yeah.
For
Actually,
being my marketing. Yeah, you're new brand designer. Perfect.
I'll just take like a nominal non-voting like board emeritus type whatever where I really won't get in your way or hold you back. My face will be on your website and then I can like put it on my LinkedIn that I'm like
Perfect.
I'm like a real kind of, I'll actually be the subprime board member where I suck and I shouldn't be there, right? But I am, you know what I mean? So Hedgex, that's where we're going, guys. All right, so the links for Pat will be in our show notes along with a number of different ways that you can support the show if you are a satillionaire, a number of different ways that you can sponsor the show if you are a company. The most important thing you can do as a satillionaire is to make sure that you are subscribed to our channel on YouTube. Our goal is to get 10,000 strong by Yule. And in exchange for reaching that milestone, we will select one from among you and drop 2 million sats on your head. It's not going to be leveraged, won't be any funny business. It'll be 2 million of our sats that go directly to a wallet that you control, okay? Make sure that you're part of that drawing. And also, don't be afraid to hit the notifications while you're there. You can get new episodes like this every day at 11 a.m. Monday, Tuesday, Wednesday, Thursday. 11 a.m. Friday is our live game show, TikTok Next Block, the game you play for 1 million sats. And last Friday, at least at the time of this recording, was out of control. We flipped into... Our first player was from outside London, and our second player was from Guatemala, and we fully flipped over into Espanol mid-show and just went hard on Bitcoin and Sat Chats trivia. So
It was wild.
my mind was like going a mile a minute trying to make the translations happen in real time.
Yeah.
It was a ton of fun. So tune in. Thanks so much for tuning in to this episode here with Pat. I got a ton of value out of it. I hope you did as well. Remember, Sat Chats is for educational purposes only. and should not be construed as financial advice. Also, our guests' views are their own. Until next time, stack those sats.
Please.
Stack them, okay?
Yeah.
Bye-bye.